Imagine standing at the edge of the biggest wealth shift of our generation. For the past 150 years, fortunes were built on oil, coal, and gas. But today, the world is entering into a new era, one where the next trillion dollars giant won't come from fossil fuels but from clean energy. Just look at the numbers. Global renewable capacity is projected to triple in solar and nearly double in wind by 2027, making renewables the largest source of electricity worldwide. In 2024 alone, electric vehicles crossed 20% of global new car sales, a milestone no one expected this soon. And behind this growth is not just the consumer demand but massive government push. The US Inflation Reduction Act has unlocked hundreds of billions of dollars in subsidies, tax breaks, and investments into solar farms, wind turbines, hydrogen hubs, EV manufacturing, and carbon capture technology. For investors, it is more than a climate story, it's a disruption story. Every sector that depends on energy, whether it is transport, manufacturing, even data centers powering AI, is being rewired. The companies solving these challenges could see the exponential growth in the next decade, and the question is, how can Indian investors participate in this transformation happening largely in the US markets? That is what we'll explore today by looking at the most promising US stocks and ETFs across solar, wind, hydrogen, EVs, and carbon. Some offer the stability of steady cash flows, while others have the growth potential of disruptive technology, and together they could become the backbone of a future-ready portfolio in this category. Now, first, we'll talk about some of the stocks, and then we'll talk about some of the ETFs. Now, the first stock on my list today is Occidental Petroleum, OXY, which is like betting on the big carbon capture. When you think about Occidental Petroleum, the first thing that comes to mind is oil, right? It is one of these America's oldest and largest oil and gas producer, but what makes it stand out in the clean energy disruption story is how aggressively it is moving into carbon capture and removal technology, an area that could become a $1 trillion market by itself. In 2023, Occidental acquired Carbon Engineering for $1.1 billion, a Canadian company that specializes in direct air capture or DAC. The idea is simple but revolutionary. Instead of just reducing emissions, you literally pull CO2 directly out of the atmosphere. Occidental now plans to build up to 100 DAC plants worldwide, with first one already under construction in Texas. If it is successful, these facilities will capture millions of tons of CO2 per year, which can then be stored underground or even reused for making low carbon fuels and products. The US government is backing this aggressively. Under the Inflation Reduction Act, companies can get $180 per ton of CO2 removed, creating a guaranteed revenue stream for early movers like Oxy. That makes carbon capture not just another good on the planet, but potentially very profitable. Financially, Oxy has the stability of its traditional oil business. Berkshire Hathaway owns about 25% of the company, signaling strong conviction. Over the last 5 years, Oxy has delivered a CAGR of 35%. The mix of steady cash flows from the oil and exponential upside from the carbon capture markets, Oxy stands at a very unique bridge between the fossil fuel and the clean energy future. So the next stock is the Rivian, EV challenger with Amazon at its back. When most people think about electric vehicles, Tesla dominates the conversation. But there is another US player making the waves. Rivian, founded in 2009, is focused on a segment that Tesla hasn't fully cracked yet, which is electric trucks, SUVs, and commercial delivery vans. One of Rivian's biggest growth driver is its deep partnership with Amazon. Back in 2019, Amazon placed a massive order of 100,000 electric delivery vans, committing to electrify its logistics fleet. By 2024, Rivian had already delivered over 20,000 of these vans, making Amazon one of the largest EV fleet operators in the world. This commercial angle gives Rivian something unique, a guaranteed buyer with global scale. On the consumer side, Rivian's R1T electric truck and R1 SUV are carving out a niche in the premium adventure vehicle space as well. These aren't budget EVs, they are high-performance, long-range vehicles aimed at lifestyle buyers who want an electric option without compromising on power or design. Financially, Rivian is still in the high-growth phase, high-burn phase. Revenue is rising quickly as production scales, but the company remains unprofitable, burning billions to build factories, expand capacity, and improve its supply chain. That means the stock is still volatile. Rivian share are still down more than 70% from the IPO highs, though they have recovered over 40% in 2024 as production stabilized. For investors, Rivian presents the growth bet in the EVs, not as stable or proven as Tesla, but with Amazon's backing, a differentiated product line, and a long runway in commercial and lifestyle EVs. If Rivian executes on scaling production and reaching profitability, it could become one of the most important EV players of the next decade. Now, the next is Plug Power. High risk, high reward, hydrogen pure play. Now, the hydrogen has been long called as the fuel of the future, and Plug Power is one of the companies trying to make that future real. Based out in the US, the Plug Power builds hydrogen fuel cells, electrolyzers, and fueling stations. Essentially, the infrastructure that allows hydrogen to replace fossil fuels in transportation, logistics, and in other industries. The company's technology is already in use. Plug supplies hydrogen-powered forklifts and on-site energy systems to giants like Amazon and Walmart, helping them decarbonize their warehouses and fleets. It is also selling electrolyzers to produce green hydrogen which is created using renewable energy. In Q2 2025, Plug reported sales of $174 million, up 21% year-on-year, and its electrolyzer business alone tripled the revenue compared to the previous year. That shows growing global demand for hydrogen solutions. But here's the other side of the story. Plug Power is still deeply unprofitable. Over the past 4 quarters, it reported nearly $2 billion in losses with margins at around 293%. The company is burning cash as it expands production capacity and builds out their infrastructure. The stock reflects the risk, down more than 70% from its 2021 highs, but also up about 25% in 2025 as investors' optimism returned on rising hydrogen orders. So what does this mean for investors? Plug Power is the pure growth play in hydrogen. If green hydrogen scales the way many governments expect, supported by subsidies, climate targets, and demand from industries like steel and shipping, Plug stands to benefit massively. But it comes with volatility. For a 5 to 10 year horizon, Plug could either become a hydrogen powerhouse or remain a cash burning bet. That is why it fits the growth bucket of a clean energy portfolio. Now, the last one is the but obvious Tesla, the established EV giant. No conversation about clean energy disruption is complete without Tesla. Tesla has become not just the world's leading EV manufacturer, but also a symbol of that electric transition. In 2022, Tesla delivered about 1.31 million battery electric vehicles, more than any other automaker, giving it roughly 17% of the global EV market. By 2024, global EV adoption had crossed 20% of all new car sales, and Tesla remains at the forefront of that surge. Unlike many younger EV firms, Tesla is profitable at scale. It operates massive gigafactories in the US, Europe, and China, which allows it to control costs and ramp up production faster than rivals. Beyond cars, Tesla also generates revenue from energy storage systems, solar products, softwares like full self-driving, making it not just an automaker, but a diversified clean tech company. From a financial perspective, Tesla has been one of the most extraordinary stories of the past decade. The stock has delivered a 5-year CAGR of 26%, turning early investors into multi-billionaires. Even in recent years, as growth slowed, Tesla's margin and cash flows have kept it ahead of most competitors who are still burning cash. Of course, Tesla isn't risk-free. It faces intensifying competition from legacy automakers and startups, plus ongoing scrutiny of Musk's leadership style and regulatory challenges around autonomous driving. But in the clean energy investment universe, Tesla plays the role of stability anchor in EVs, already profitable, globally scaled, and still with huge growth potential in new markets and technologies. For investors, it's the core EV stock to hold if you want exposure to the sector without betting on still unproven challenger. Now, these were the 4 stocks that we wanted to discuss. Now, let's move on to the ETFs. The number 1 on the list is the KRBN, Crane Shares Global Carbon Strategy ETF, which is like investing in the price of carbon. One of the most overlooked ways to invest in clean energy disruption isn't through just solar panels or electric cars, but through carbon markets as well. As governments tighten the climate rules, companies are forced to buy credits for every ton of CO2 they emit. The fewer credits available, the higher the price of emitting carbon, and that is where KRBN comes in. The Crane Shares Global Carbon Strategy ETF is the world's largest carbon credit ETF. Instead of owning companies, it holds futures linked to major carbon markets, including the European Union Emissions Trading System, California's Cap and Trade Program, and the UK's carbon market. These are some of the most developed and liquid carbon allowance markets in the world. What makes this powerful is the built-in scarcity. Governments reduce the supply of credits over the time, which naturally drives up the prices. In the last 5 years, KRBN has delivered a CAGR of 10%, and in the past year alone, it returned about 7.5%, even as equity markets were volatile. That is because carbon pricing doesn't follow traditional stock cycles, it follows regulatory pressure, climate targets, and corporate demand. For investors, KRBN adds a completely different layer of exposure to the clean energy transition. It is essentially a bet as the world gets stricter about emissions and the cost of pollution will rise. And what are the potential risks? The policy changes. If government slows down climate action, carbon prices may stagnate. But over a 5 to 10 year horizon, as climate commitments tighten globally, carbon credit markets are expected to expand, giving ETFs like KRBN strong growth potential. Now, the next one is TAN, Invesco Solar ETF, riding the global solar boom. Now, solar energy isn't just the future, it's already the fastest growing source of new power capacity worldwide. According to IEA, global solar capacity is expected to triple by 2027, overtaking even coal as the largest source of electricity generation. For investors who want a broad exposure to this boom without betting on a single company, this ETF is one of the best options. TAN tracks the MSCI Global Solar Energy Index, which includes the leading players in solar manufacturing, installation, and technology. Its top holdings are First Solar for about 9.7%, along with major names like Solar Edge, Enphase Energy, and the Next Tracker. It also has exposure to global players, including Chinese manufacturers, giving investors worldwide spread of solar leaders. Performance has been impressive but volatile. Over the past 5 years, TAN has delivered a CAGR of 32.97%, reflecting the massive growth in solar demand. In 2023-24, while the sector faced headwinds from rising interest from input costs, TAN held steady compared to many individual solar stocks that fell sharply. Now, that is the benefit of diversification. It balances the ups and downs of different players. What makes TAN compelling for the next decades is its policy disrupt and cost declines. In the US, the Inflation Reduction Act, which I mentioned earlier, is driving billions into solar manufacturing and deployment. Globally, solar is already the cheapest source of new electricity in many regions. The risk is short-term volatility. Basically, the module prices, subsidies, and supply chains can cause swings. But over the 5 to 10 year horizon, TAN gives investors a front row seat to the solar revolution in a single diversified package. Now, the next is QCLN, First Trust Nasdaq Clean Edge Green Energy ETF. Tech meets clean energy. If you want exposure not just to solar or wind, but to a broader technology-driven side of the clean energy market, then the First Trust Nasdaq Clean Edge Green Energy ETF is a complete standout. Unlike many sector ETFs, QCLN isn't narrowly focused. Instead, it blends EV manufacturers, solar leaders, and enabling technology companies, giving you a more balanced approach to the clean tech ecosystem. Its holdings cover the big names driving disruption. QCLN includes Tesla as the top weight, but also holds Enphase Energy and Solar Edge, which are leaders in solar inverters. Along with companies like the battery, smart grid, and EV supply chain space, this makes it a very diversified clean tech basket rather than just a renewable play. Now, the performance has been strong compared to peers. Over the past year, QCLN has returned a CAGR of 25%, reflecting the sharp growth in EV adoption and solar expansion. During 2021, the boom in clean tech stocks, QCLN surged, but it also corrected in 2022-23 as the interest rates rose, a reminder that clean energy equities can be cyclical. Still, over a 5 to 10 year horizon, the ETF provides a consistent exposure to the companies which are at the forefront of electrification and decarbonization. What sets this ETF apart is that it is leaning towards on both hardware and software tech enablers. That gives it resilience compared to funds that are tied to just one subsector. For Indian investors, QCLN can be the core clean tech ETF allocation, which is less narrow than a solar-only fund like TAN, but with more growth punch than broad ETFs like ICLN. So that's it, guys. I hope you liked the video. We tried to cover what clean energy has to offer in the US markets, both from the stocks perspective and from the ETF perspective. Let us know in the comments which are some of the companies that you are tracking, which are the ones that you liked or you have personally invested in. Thank you so much. Subscribe to the channel and keep watching for more videos.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.